At the beginning of the 1900s, buying a home was not a normal dream for normal people. It was mostly a privilege for the wealthy. Banks already understood that mortgages could make them money because when people borrow to buy a house, they spend years paying interest. But there was one big problem. Almost nobody could qualify. Back then, a typical mortgage looked nothing like what we know today. A buyer might need to put down 50% up front. Then they would pay interest for a few years, and at the end, they would still owe one giant payment. So if a house cost $100,000, the buyer might need $50,000 immediately. Then they would pay interest for 5 years, and after all of that, they still had to pay the remaining $50,000. For a regular worker, this was impossible. So banks had a problem. They had a product that made them money, but only a small part of the population could use it. And if you are a bank, that means one thing. You need to make debt easier to sell. Because if only the richest 1% can buy homes, then you only collect interest from the richest 1%. But if you can redesign the system so that millions of regular people can afford the monthly payment, then suddenly the amount of interest you can collect becomes enormous. And that is exactly what happened. Homeownership was transformed from something rare into something that looked normal. And today, most people do not even question it. They simply accept that owning a home means spending decades in debt. Not because they are stupid, but because the system was built to make the debt feel like a dream. That dream became known as homeownership. And in America, it became part of the national identity. The American dream. But the financial structure behind that dream is much darker than most people realize. In the 1930s, the United States was in the middle of the Great Depression. The economy was broken. People were unemployed. Banks were under pressure. And the government needed a way to restart economic activity. So during Roosevelt's New Deal, a new housing system began to take shape. One of the biggest changes was the creation of federal mortgage insurance. The idea was simple. If banks were protected against borrower default, then banks would be more willing to lend. And if banks were more willing to lend, then more people could buy homes. On the surface, this sounded like a solution. More loans, more buyers, more houses, more economic activity. But incentives matter. And when you protect the lender from risk, you change the behavior of the lender. Suddenly, banks had less reason to be careful. They could issue more mortgages because if something went wrong, part of the risk was no longer fully theirs. This opened the door to a new kind of mortgage. Longer terms, lower down payments, smaller monthly payments, and much more debt. Instead of needing 50% upfront and one huge payment at the end, buyers could now put down much less money and pay monthly over time. At first, this seemed like progress. A house that used to be available only to the wealthy was now within reach for more of the middle class. And compared to the old system, it really did feel easier. A buyer could pay less upfront, avoid the giant final payment, and spread the cost across many years. But once more people could buy homes, something predictable happened. Demand increased. And when demand increases faster than supply, prices rise. So the same system that made homes easier to buy also helped push prices higher. Then the monthly payments started becoming difficult again. So the solution became obvious. Stretch the loan even longer. And this is where the 30-year mortgage enters the story. The 30-year mortgage changed housing forever because it made expensive homes look affordable. Not by making the home cheaper, but by spreading the payment across a much longer period of time. That is the trick. A lower monthly payment feels safer. It feels manageable. It feels responsible. But it hides the real cost. Because the longer the loan lasts, the more time interest has to work against you. This is where amortization becomes important. The word sounds complicated, but the idea is simple. In the early years of a mortgage, most of your payment does not go toward owning the house. It goes toward interest. You feel like you are paying down your home. But for years, the bank is collecting most of the benefit. This is why a 30-year mortgage is so powerful for banks. The payment looks smaller, but the total interest becomes massive. Take the same loan amount. the same interest rate, and stretch it over 30 years instead of 10 or 15. The monthly payment goes down, but the total amount paid to the bank goes way up. The enemy is not only the interest rate, the enemy is time. Because time allows interest to multiply. And that is why a home can feel affordable every month while still becoming one of the most expensive financial decisions of your life. The system does not need you to understand the full cost. It only needs you to focus on the monthly payment. Because if the payment feels manageable, you sign. And once you sign, the bank has something much more valuable than a sale. It has decades of your future income. That is the part most people never see. A mortgage is not just a loan. It is a long-term claim on your labor. And the longer the loan lasts, the more powerful that claim becomes.
Now this is exactly where the real trap begins. On the surface, everything looks perfect. A 30-year mortgage gives you a lower monthly payment. It feels easier. It feels safer. It feels like the smart move. But the reality is completely different. People are wired to choose short-term comfort. Saving money today feels like winning, but in reality, you are sacrificing your future without even noticing it. Almost nobody stops and calculates the full cost. Almost nobody thinks about how much they will actually pay over decades. Everyone is focused on one simple question: can I afford this monthly payment? And that is exactly how the system was designed to work. People were not just sold houses, they were sold a belief. A house became a symbol of success, just like having a degree, just like having status, just like proof that you made it in life. And once that belief was planted, millions of people followed it without questioning anything. But here is the part no one really talks about. A 30-year mortgage was never truly designed for you to finish it. It behaves much more like a casino system. Yes, some people will win, but the system itself always wins. Let me show you how this actually plays out. You buy a house, you move in, you feel proud, you feel accomplished. A few years pass, maybe 5, maybe 7. Then life changes. You get a better job in another city. You start a family and need more space. You simply want something bigger. So you sell your house and upgrade. And in your mind, you think you are progressing. But when you look at the numbers, you realize something shocking. During the first 7 to 10 years, most of your monthly payments went almost entirely toward interest, not toward the actual debt. You barely reduced the principal, which means you were not really buying the house. You were paying the bank for the right to live in it. And now you start again from zero. New house, new mortgage, another 30 years. And once again, the early years are dominated by interest payments. This is where the cycle locks people in. It repeats again and again.
People today are more mobile than ever. They change jobs, they change cities, they relocate constantly. The average person will switch jobs more than 10 times in their lifetime. And almost every major life change leads to a new mortgage. So what actually happens? By the time most people reach their 50s or 60s, they are still carrying debt, still paying the bank, still stuck in the same cycle. And the most surprising part, most people do not even realize it because they are focused on the wrong thing. They look at the interest rate. Oh, I got 3%. I got a great deal. But that is not where the real game is. The interest rate is just a marketing tool. Banks figured something out decades ago. People do not stay in one house for 30 years. They move. And every time they move, the entire loan resets, which means the interest resets, which means they start paying the most expensive part of the loan again and again and again. So even if the rate looks low, the total interest paid over a lifetime becomes massive, far higher than people ever expect. But you never see that full number because all your attention is on the monthly payment. That is the illusion. You are made to feel like you are saving money, while in reality, you are committing decades of income to the system. This is why banks can offer lower rates and still make more money than ever, because they are not relying on one long loan. They are relying on multiple cycles, multiple resets, multiple rounds of interest over an entire lifetime. And once you understand this, everything changes. You stop looking at the monthly payment as the goal, and you start seeing the system for what it really is. So remember this, the moment you start playing by the bank's rules, you are no longer in control. And if you truly want to understand money,
You have to stop thinking short term. Stop focusing on what feels comfortable today and start looking at the full picture, because that is where the real cost is hidden. Because the truth is, this system was never built for you. It was built for the banks, and they do not want you to understand how the game actually works. Mortgage payments today take up around 31% of the average American household income. 31%. Think about what that really means. It means people are spending almost a third of their entire lives working just to pay the bank. A third of their life working for someone else's system. And when they die, that cycle does not end. Their children step into the same system, the same structure, the same debt. So calling it debt slavery is not an exaggeration. It is exactly what it looks like. And when you step back and actually see the full picture, you have to admit something. This is one of the most genius systems ever created. It is one of the most powerful business models in history.
And we have not even touched mortgage-backed securities yet. That is a whole different level. But let's say you are aware of the trap. You decide to play it smart. You take a mortgage only when you are sure you will stay in that house long enough to pay it off. You think you avoided the system. Not so fast, because banks have another move ready for you, another layer of the game. This is where refinancing comes in, and this is where things get even more dangerous. Imagine this. Someone buys a house at a 7% interest rate. A year later, rates drop to 5%. Suddenly, refinancing looks like a smart move. Lower rate, lower monthly payment, more breathing room. It feels like a win. But look deeper. What is actually happening? Banks know something you do not. Acquiring a new customer is expensive. Marketing, ads, sales. Sometimes they barely make money on the first deal. Sometimes they even lose money just to get you in. But once you are in the system, that is when the real profit begins. Because now you are a returning customer, and returning customers are where the money is made. So what do banks do? They wait a few years. They collect interest, then they come back to you with a new offer. Hey, we have a better rate for you. Come refinance, start a new loan. And suddenly you are back at year zero again. Another 30-year mortgage, another cycle of interest payments. And they sell it to you perfectly. You are paying $600 a month. We can drop it to $550. Sounds like a no-brainer. And people fall for it again and again because it feels like saving money. But in reality, you are extending the timeline, resetting the interest, and committing even more years of your life. This is why refinancing is one of the most profitable businesses in finance. Mortgage brokers, banks, investment firms, they all benefit from it because every refinance creates new loans, new fees, new commissions, new products to sell. And this is where it gets even more interesting because there's another incentive behind all of this: Wall Street. Wall Street runs on mortgage-backed securities. They need more loans, more debt, more mortgages to bundle and sell. So the system is designed to push people into borrowing more, again and again. And they will spend billions on marketing to make sure it happens. You've probably seen it yourself. Refinance today, get a better rate, lower your payment, get cash back. Sometimes even ridiculous offers, free bonuses, gifts, promotions, all designed to get you back into the system. Because every time you refinance, someone is making money, and it's not you. On top of that, banks also earn from origination fees, processing fees, all kinds of hidden costs, sometimes 2 to 4% of the loan. So on a $100,000 loan, they can make thousands instantly just for setting up the deal. So ask yourself, what is their real incentive? To help you or to keep you in the system as long as possible? And it doesn't stop there. Remember how mortgages went from 10 years to 15 years to 30 years because houses became more expensive? Well, what happens next? The next logical step, 40-year mortgages. They are already being tested, and when people can't afford those, it will become 50, because the goal is simple. Make the monthly payment look smaller, even if the total cost becomes massive. Stretch the timeline. Keep people paying longer and longer and longer. So now the real question is, how do you actually beat the system? If you don't own a home yet, should you rent? Should you buy? Should you take a mortgage? And if you already have one, what can you actually do to break out of the cycle? That's what we are going to break down next.
So now, let's answer the real question. What should you actually do? Especially if you are just starting out. You are in your 20s, you are making money for the first time, you are thinking about your future. Should you buy a house or should you rent? Here's the truth. The most important thing you can do is understand the system. Because the moment you understand how the game works, how it is structured, and who it is built for, you start seeing things differently. And once you see it, you cannot unsee it. Most people are not playing to win. They are playing a game that was designed for them to lose. And the problem goes far beyond mortgages. This applies to money, to investing, to building wealth in general. Most people follow the same path. Work for 40 years, put some money into retirement accounts, maybe invest a little in stocks, maybe try crypto, and hope it works out. That is the default plan. But what most people never realize is that there are other ways to play the game. There are other strategies, other systems, other ways to build wealth, and many of them have far greater upside. Starting a business, building high-income skills, using different real estate strategies, leveraging financial tools the right way. These are things most people never explore, and that is exactly why they stay stuck. The same applies to housing, because once you understand how mortgages actually work, you also realize something important. You do not have to play the game the way it was designed. There are ways to move differently. There are ways to structure your money in a smarter way. There are ways to pay off a mortgage much faster, not by working harder, not by begging the bank, not by refinancing into another trap, but by controlling your cash flow, by controlling where your money sits. Because here is something most people never think about. If your money is sitting in a normal bank account, the bank is winning every single day. Your money is doing nothing for you, but the bank is using it. They take your deposits, they leverage them, they lend more money, they create more loans, and they profit from your money while you earn nothing. You are literally giving the bank an interest-free loan. So instead of doing that, you have to start thinking differently. There are other financial tools, credit lines, different liquidity strategies, ways to move your money so that it actually works for you. This is how you reduce interest. This is how you speed up the process. This is how you avoid being stuck for 30 years. Because the goal is not just to buy a house. The goal is to stay in control. So let's make this simple. If you are planning to live in one place for at least 10 years and you are committed to that decision, then yes, buying can make sense. But if your life is not stable yet, if you are still moving, exploring, figuring things out, then locking yourself into a 30-year contract is probably not the smartest move. Take your time, figure out where you want to be, and only then make the decision. Because most people rush into it and spend decades paying for a decision they did not fully understand. And if you already have a mortgage, then understand this: you are not stuck. There are ways to move faster. There are ways to break the cycle. There are ways to get out earlier. But it starts with awareness. It starts with understanding. It starts with seeing the system for what it really is. Because once you understand the rules, you can finally start playing to win and not just survive. So if you want to actually take control of your money, if you want to understand how the system really works and how to move differently, make sure you subscribe. Because most people will never learn this, and by the time they realize it, it is already too late. Don't be one of them. I will see you in the next video.